Hello friends, welcome to Kavita's classroom. In this video, we are trying to cover what's the impact of elasticity of supply on the incidence of tax on buyers and sellers. So let's proceed with the help of some diagrams and some written explanation. So we know tax is a mandatory levy which is levied on individuals and organizations by the government entities and which can be local, state and national government. Right. And this is one of the most important fiscal policy tool of the government. So why the government imposes taxes? It's a great source of revenue for the government, right? Then to control the market failures. Market failures means when the demand and supply forces and the free market determines the quantity of some goods which have negative impact on the society and which should be less produced, right? So government tries to put some taxes so that the quantity produced and consumed is lowered by that action, right? So it tries to control those negative externalities by imposing certain taxes. And then it also controls the boom and depression situations and inflationary and deflationary situations and reduces the inequalities by redistributing the income. So let's understand how does it look like on the diagram. This is the basic structure of demand curve and supply curve and equilibrium here and the price and the quantity. So this is the basic structure. But after the imposition of taxes, what happens? The supply is reduced. So it shifts leftwards or you may say upwards, right? So this much is the per unit tax which is imposed by the government, and as per the new equilibrium is here at E dash point where on the previous demand curve new supply curve intersects and you have new price which is the new price OP dash is greater than OP the previous price and new quantity is lesser than OQ, the previous quantity as determined by the free market forces. So this way the government tries to control the market failures, right? So in this case, what is the tax? The tax revenue is this whole area. Why this whole area? Because per unit tax is this. See, this is per unit tax as it is clear that this vertical distance between S dash and S is the per unit tax and the new quantity traded is this much. So the area of a rectangle is length into breadth and this way we can find the tax revenue. And in this structure we see that the tax contributed by the buyer is this area which is above the P price, means any addition to the price would be contributed by the buyers and the area which is below P would be contributed by the seller. But this is not always the case because here it also depends upon the elasticity of supply and the burden gets shifted to some other party. So let's understand how it happens in case of elastic and inelastic supply curve. So this here in this first case, elasticity is greater than 1. You see a flatter supply curve. This is a flatter supply curve, original supply curve. And here this is less elastic demand, so it is a steeper and vertical oriented supply curve. So what happens? See, with this unit tax, the supply curve gets shifted to left or upwards. Here the unit tax is this. So this is the whole tax structure. This is the whole tax structure. But we see where is the bigger box? You know, any price which is over and above this previous price. So this is contributed by the buyer. In this case, the buyer is contributing more. And here in this case, the buyer is contributing less. Whereas if you compare, the seller is contributing less here. In this case, it's only this much. And here, seller is contributing more. It is higher. So, what do we get to understand out of this diagrammatic presentation? See, when it comes to supplies, if supplies are elastic, means the consumers are not very sure of whether the things would be supplied or not. So, they are ready to take the risk, and hence they are ready to pay more. So the burden gets shifted to the consumers or the buyers when the supply is elastic. But when supply is inelastic, it becomes contrary. On the contrary, the sellers take major burden. So what is the crux of this understanding? When the elasticity of supply goes up, it is the consumer who is paying more taxes and contributing more towards the tax incidence. But when the elasticity falls of supply, right, producers contribute more to the tax. With this, we come to the closure. Thanks for watching. Bye bye. See ya.